If you look at the market right now, I mean, the whole narrative is just dominated by these huge macro forces.
Oh, absolutely. Inflation, interest rates, global conflict.
But sometimes a massive opportunity can boil down to just one simple question. Who is placing the biggest bets and why? We're talking about signals of supreme confidence.
And today, that's exactly what we're doing. We're diving deep into an analysis report that's really captured a slice of the market's attention.
And it's making a pretty sensational claim, right?
A very high conviction claim,
Yeah.
all centered on one single blue chip stock, Nike, ticker NKE. It just saw a sharp, 4.64% surge right up to the $60 mark.
Okay, let's unpack this. The core idea driving this entire report, and the reason we're doing this deep dive, is something they're calling the ultimate insider confidence signal. The claim is that Tim Cook, CEO of Apple, who also happens to be Nike's lead independent director, is loading the boat with shares.
So the mission for us, and for you listening, is pretty simple. We need to break down the specific, multifaceted rationale that this analysis presents.
Why does this source believe this is the massive under-the-radar catalyst, the thing that justifies an aggressive, high-conviction trade to buy Nike right now?
It's a really compelling setup, isn't it?
It is. You've got this global giant that's been, frankly, beaten down all year, and then suddenly this super confident report comes out arguing one of the most respected CEOs in the world is buying aggressively.
So we have to figure out what's the evidence? What is the report actually using to validate this idea that now is the moment to buy the turn?
Exactly.
All right, let's start by contextualizing this catalyst, because the signal isn't just about who is buying, it's about when. The report really emphasizes timing above all else.
Okay.
This signal is seen as so important because it's happening when the stock was trading near its 52-week lows. I mean, it had just touched $52.
A price where, let's be honest, the consensus was screaming short or sell.
Oh, absolutely screaming it.
So that immediately frames this as a contrarian narrative. The source is telling you, you have to buy when there's blood in the streets.
And this is where Tim Cook's role is so important. This isn't just some friendly outsider making a small bet. The report really leans on his specific authority.
Let's dig into that.
What's fascinating is just how long Cook has been there. He sat on Nike's board since 2005.
Wow. Since 2005.
Think about that. That's nearly 2 decades. He is deeply, intimately familiar with the company's inner workings, its supply chain, its culture, and its long-term product pipeline.
And as lead independent director, his role is even more significant, right? Stronger oversight.
Much stronger. So if Nike is in the middle of a complex turnaround, which we know they are, dealing with inventory and shifting their product focus,
Cook knows exactly where they are in that process. He's not just guessing from a press release. He's looking at the internal dashboard.
Precisely. So the argument in the report is that his alleged insider buying isn't just a casual investment. It's an incredibly powerful statement to Wall Street.
A statement.
Yeah, a direct declaration that the current bear arguments, all the negativity around the stock, are just factually wrong when you consider what's coming next.
Okay, this is probably a good place to pause and really scrutinize that claim. The whole thing hinges on this idea that Cook is loading the boat. Are we talking about confirmed SEC filings here, or is this the analysis report, interpreting public info and reading the tea leaves of conviction?
That is the crucial distinction, and the report is masterful at blurring that line between confidence and verified fact.
How so?
The way it's framed suggests this high level of internal certainty. It implies Cook's buying is a known quantity among sophisticated investors. It treats the signal as an absolute vote of confidence.
And the analysis even gives a little definition for why this type of buying matters so much.
It does. It argues that when an insider buys shares on the open market, as opposed to just getting options,
there's only one reason. They think the stock is going higher.
Right. It's management backing their own talk with their own money. That's the weight they're putting behind this high-stakes entry point.
Okay, so this is where the narrative pivots. If we accept the premise, just for a moment, that a super-informed insider is this confident,
then you have to ask, what external verifiable data actually supports that confidence?
That's the perfect transition. A smart money signal is compelling, but you have to back it up with fundamentals. And the report is quick to tell you exactly which negative stories to ignore.
Yeah, they name them directly. The whole idea that China is weak or that competition is too high.
A clear shot at On and Hoka.
A very clear shot. The instruction is to just dismiss that noise and look directly at the latest numbers, specifically from the company's Q2 FY 2026 earnings.
Okay, so let's drill down. What are the specific financial figures the report is citing? Let's start with profitability.
Right, so the report highlights a key win. Earnings per share came in at 53 cents.
And more importantly,
it beat estimates. And in a turnaround story, beating EPS isn't just a nice to have. It shows that cost controls and, operational efficiency are working better than the market thought. It gives a solid foundation to the whole bull case.
And for a company in transition, especially with that inventory glut we mentioned, revenue has to stabilize. What did the report find there?
It noted that revenue is stabilizing at $12.4 billion.
Which is huge.
It's a crucial data point. It directly contradicts the fear of some massive accelerating slowdown. It suggests they've found the floor and that the drop in demand the bears were worried about. It's either not happening or the company has managed to contain it.
So if we connect that to the big picture, it sounds like the company is successfully managing the sort of painful part of its restructuring, and the report uses margin data to prove this pain is productive.
Absolutely. They point out the margins are holding up despite the current discounts.
Okay, that's the key insight.
It really is. Nike is deliberately discounting old stuff to clear out inventory. That naturally pressures margins. But the report argues that the fact the margins are holding up better than expected shows discipline. It shows they have strong pricing power on the new products coming down the line.
They're clearing the decks.
Successfully clearing the decks.
So the fundamental picture here is a company that's executing a necessary strategic retreat. The report calls it being in win-now mode, preparing for a major push.
And that push is the massive 2026 product cycle. That's the future payoff that this insider confidence is supposedly signaling.
This leads right into the core timing argument. And for anyone trying to understand how markets work, this is probably the most important takeaway from this whole section. They basically warn you that waiting for confirmation is a losing game.
Yeah, they state it very clearly. The market is forward-looking, right? It prices in success 6, maybe 12 months in advance. Their claim is that if you wait for the perfect earnings report or for the 2026 product line to be a verified hit,
the stock will already be at $85.
Exactly. The opportunity is gone.
The strategy, then, is crystal clear. We are buying the turn, not the news. You have to get in now before the market fully prices it all in. And the alleged Tim Cook buying is the signal that the inflection point is here.
So we have the why, the confidence signal. We have the stabilizing financials. Now we need the where, the technical setup that gives you the precise entry and exit for the trade.
Right. Moving past the insider story and the fundamentals, we have to look at the chart. And the report spends a lot of time on this, describing the technical setup as beautiful.
The technical breakdown really gives you the risk context. The report first identifies this key support level, which they call the concrete floor.
Okay.
This was established by a double bottom pattern right around the $52 mark. For anyone who follows technicals, a double bottom is a really strong psychological signal. It suggests sellers tried twice to push the price lower and failed. It implies a really robust base of support.
So that $52 floor defined the risk for the past year, but the entry signal wasn't 52, it was 60. What technical event made buying at that higher level the right move?
According to the report, it's that the stock smashed through the $58 resistance and held 60.
And breaking a previous ceiling like that is seen as a decisive shift.
It is. The balance of power has moved from the bears to the bulls. It confirms, on the charts, that the turnaround story is gaining traction.
And it wasn't just that it broke through 58, right? The volume was a big part of the story.
Oh, a huge part. High volume on a breakout confirms conviction. And the report really emphasizes this, stating it points directly to institutional buying.
Which means it wasn't just shorts covering or retail hype. This was large, smart money funds starting big new positions, aligning themselves with that alleged insider signal. So if you're looking at this deep dive, the analysis has now combined 3 powerful pillars. The insider signaling a turn, the fundamental data showing the restructuring is working, and the technical chart confirming that institutional money is now following that signal.
And now that those pillars are established, the report shifts from analysis to an explicit operational strategy. This is where they lay out the specific trade plan.
Let's walk through the logistics. They define the strategy, starting with the entry point at $60, the exact level where they're telling you to be loading the boat.
And the risk management is incredibly precise. The stop loss is set tight below $57.
Right.
The report calls this the gap fill. In technical terms, a gap is that price range the stock jumped over during the breakout. Setting the stop there is a way of saying if this bullish move fails and the stock drops back to fill that void, you get out immediately. The risk is contained.
That's a pretty tight stop. $3 of downside on a blue chip stock. What's the intended payoff? What are the price targets?
They set 2 key targets. The first is $73, which was a previous resistance area. And the more ambitious second target is $80 or even higher. So that frames the potential upside against that very specific downside risk.
Hold on a minute, though. A $3 downside versus a potential run to 73 or 80. Is that a fair comparison? A tight stop assumes immediate success, but the target requires the whole 2026 product cycle to play out over months.
That's a great question.
Doesn't that risk-to-reward ratio kind of ignore the fact that the Tim Cook part is an interpretation, not a guarantee?
It does raise a question about the report's conviction level, but they quantify it. They call this a 4-to-1 risk-to-reward ratio based on that first $73 target.
And they argue that's rare for a company like Nike.
They say it's almost unheard of, implying this setup is an anomaly. The tight stop is their way of saying, if we're wrong about the turn starting now, we get out immediately and take a small loss.
So their bullish conviction basically boils down to this. You combine a beaten-down giant, a technical breakout with institutional volume, and the alleged involvement of insiders like Tim Cook. And the conclusion is that probability is just overwhelmingly on the bull side.
And the final expectation from the report is that you should be prepared to hold this for the medium term. You're specifically waiting for that move toward the $80 target as the market eventually catches up to what Cook allegedly already sees.
So we've now gone through the entire case for buying Nike at $60, all based on this one high-conviction analysis report.
We've distilled its three main pillars. First, that unique insider confidence factor, driven by Tim Cook. Second, the stabilizing Q2 financials, with the EPS beat and revenue holding up.
And third, the technical entry point, defined by that $52 floor and the confirmed $60 breakout on huge volume.
That's the whole case.
So what does this all mean for you? Well, regardless of whether you'd ever act on a trade idea this aggressive, this report provides a fantastic framework. It shows you how to use high-conviction signals, rumored or confirmed, as an indicator of market shifts.
It really shows you how sophisticated analysts can synthesize these different things. Insider signals, stabilizing fundamentals, and chart confirmation all into one single cohesive story.
And that raises a really important question for your own long-term thinking.
It does. If success in investing is all about probability, like this report claims, how do you distinguish in real time between confident rumors, like this ultimate insider confidence signal, and confirmed data, especially when you're trying to assess a turnaround before that big 2026 product cycle actually hits?
And maybe more broadly, how much weight should you really put on the involvement of a high-profile figure like the CEO of the world's biggest tech company when you're evaluating the future of a completely non-tech, fashion-forward company like Nike? That complex intersection of celebrity influence and financial reality, that's really what you need to ponder as you look at these kinds of high-conviction calls.